You take a loss right where your stop was supposed to catch it, clean, no surprises, the plan doing exactly what it was built to do. And within a minute, you're already back in, double the usual size, on a setup you'd have scrolled straight past an hour earlier. That one loses too. So you go again, bigger still, barely glancing at the chart at this point, just needing the number back to where it was this morning. Ask yourself about it later, calmly, and there usually isn't a real answer waiting. It didn't feel like a decision at the time, it just happened. So what's actually driving that? Most people call this revenge trading and stop there, treating it like a pure discipline failure, something you fix by calming down and trying harder next time. But that explanation skips the part that actually matters. Increasing your size and abandoning your own rules right after a loss isn't random, and it isn't purely emotional either. It's a specific, well-documented pattern built from two separate mechanisms, one about exactly what kind of bet suddenly becomes appealing the moment you're down money, and one about what that loss is actually doing to you underneath, which has surprisingly little to do with the dollar amount itself. Start with Eric Johnson, a decision researcher who worked alongside Richard Thaler on one of behavioral economics' most direct studies of this exact moment. Their experiment put people through a sequence of gambles, tracking how a person's choices shifted immediately after they'd already won or lost on the previous round. The gambles that came right after a loss produced a strange, consistent pattern. People became dramatically more willing to accept a risky bet, but only when that bet offered a real chance of landing back at exactly zero, at breaking even when a different bet sitting right next to it, equal in size and equal in odds, was mathematically just as good or better without that specific break-even feature attached. The experiments didn't stop at one round either. Thaler and Johnson tracked people through repeated sequences of gambles, watching the exact same person's appetite for risk swing depending purely on whether the previous round had left them up or down, with nothing else about the person or the gamble itself changing in between. That's part of what makes the finding hard to write off as one person's bad habit or a quirk of personality. The same person offered the exact same terms, made measurably different choices purely based on which side of zero their running total happened to sit on in that moment. That's worth sitting with for a second. The number zero itself was doing most of the work, not the actual expected value of the gamble. A bet that could get someone back to precisely where they started got chosen over an objectively fine alternative, purely because of what that one specific outcome represented. Johnson and Thaler called the pattern the break-even effect, and its quieter twin, the house money effect, showed the same reference point working in reverse. After a win, people gambled more freely with the fresh profit, treating it less like their own money and more like money they never really had to lose in the first place. Now put the break-even effect directly next to that third oversized trade. It wasn't chosen because it looked like the best setup of the day by any objective measure. Based on Johnson's research, it was chosen because it offered a shot at erasing the loss exactly, at landing back on that one specific number, regardless of whether it held up as a good trade by any other standard. The setup quality wasn't really the point. The zero was. Why zero, though? Why does getting back to precisely even matter so much more than a trade of identical size and odds that would leave you at a small profit instead of flat? Johnson's research points to something called reference point framing. Your account balance itself becomes the line in the sand, and any outcome that leaves you below where you started registers as an active, ongoing loss, no matter how small the amount actually is in absolute terms. That's why a trader can be up for the entire week and still take genuinely reckless risk chasing back a single bad afternoon. The zero being chased was never really a financial number. It was the exact point your brain quietly drew the line at for acceptable versus not acceptable. Welcome back to Trading Psychology Animated. Today, we're going to unpack why one bad trade so easily turns into three, and what the actual research-backed fix looks like once you know what's really happening underneath it. If any part of that break-even pattern is already sounding familiar, this is a good point to hit like and subscribe, because the next part is where this gets genuinely useful. Knowing about the break-even effect explains why that first revenge trade gets chosen. It doesn't fully explain why the size keeps escalating, trade after trade, well past any rational point where a person should have stopped. That's where sociologist Henry Lessier's research comes in. Lessieur spent years studying compulsive gamblers directly, through extended interviews rather than lab experiments, and identified a pattern he called the chase, a term that's since become standard in the clinical literature on gambling behavior. What he found broke from the assumption that people chasing losses were simply making a series of bad rational bets. In his interviews, the pursuit stopped functioning like a bet at all. It started functioning like an urgent attempt to make an unbearable feeling go away right now, regardless of the odds actually being offered. Lessieur documented something specific about how the size escalates inside a chase. A bet that would have felt completely reasonable an hour ago stops feeling like it would resolve anything once someone is deep enough into a losing sequence. Only a bigger bet still feels like it could actually fix the underlying problem, which isn't really the money at that point. It's the intolerable, unresolved feeling of being down and needing that feeling to stop immediately. That's why the position sizes in a chase climb the way they do. It was never really about finding the best trade. It was about finding a trade big enough to make the discomfort go away. Lessieur later helped develop one of the standard clinical screening tools used to identify problem gambling, and chasing losses sits right in the center of it, not as a minor symptom, but as one of the clearest behavioral markers clinicians look for. That's a useful thing to know because it means this specific pattern, bet size climbing specifically to resolve an unbearable feeling rather than to capture a good opportunity, isn't a vague or subjective idea. It's specific and recognizable enough that it's used as a diagnostic marker. Translate that directly onto the trading day from the opening. The first oversized trade was Eric Johnson's break-even effect, a bet chosen for its shot at exactly zero. But by the third trade, with no real signal behind it and no connection left to the actual plan, that's Lesseur's chase fully underway, size increasing specifically because a smaller, more reasonable trade no longer feels like enough to resolve what's actually driving the behavior. The trader isn't really evaluating setups by that point. They're trying to make a feeling stop. Here's the counterintuitive part, and it's the actual answer buried in the video's title. The real reason you can't stop was never primarily about wanting the money back, even though that's the story it tells itself in the moment. Getting the money back is the surface explanation your brain hands you, because it sounds rational, and it's easier to sit with than the real driver underneath, which is an urgent need to escape an intolerable psychological state as fast as possible. That's exactly why the trades taken during a chase so consistently ignore setup quality, position sizing rules, and everything else that governs every other trade of the week. A rational profit motive doesn't behave that way. An escape response does. You can see the same shape well outside trading too. A blackjack player who loses a modest hand and calmly walks away is a completely different person from that same player 3 losing hands later, doubling their bet on a hand they wouldn't have looked twice at earlier in the night, chasing the exact feeling Lessieur documented decades ago. Someone who has one bad, expensive day and then makes an impulsive, oversized purchase they'd never normally justify is running the same pattern in a completely different context, reaching for something, anything, that might make the discomfort of the day stop mattering. A weekend poker player up several $100s for the night, then back down to exactly zero on one bad hand, plays sensibly for an hour afterward before finally pushing a big stack in a hand barely worth calling, chasing that same specific number Johnson's research predicts, not a strategically sound spot at the table. So, what does actually fixing revenge trading look like, instead of just being advice people repeat without ever building it into anything real? Based on Johnson's and Lesseur's findings together, trying to calm down in the moment doesn't work, because by the time the urge shows up, you're not evaluating trades rationally anymore. You're already mid-chase. The fix has to be structural, built before that state ever has a chance to take hold. A hard rule that position size can never increase after a loss inside the same session set that morning while you're thinking clearly directly blocks the exact mechanism Johnson's research identified. A fixed cooling-off period after any loss past a certain size, no new trades allowed until it passes, gives Lesseur's chase nothing to escalate because the next bet simply isn't available yet. And treating the urge to make it back right now as the actual signal to stop rather than a signal to act on turns the very feeling that used to trigger the chase into the cue that ends it instead. One more piece worth building in: a hard daily loss limit, decided before the session opens and enforced regardless of how confident the next setup looks in the moment. Lesueur's interviews found the chase rarely ends on its own once it's underway. Someone deep in it doesn't spontaneously decide the next bet is the one to skip. It ends when the option to keep going is simply removed from the table. A daily loss limit does exactly that mechanically. Closing the platform, walking away from the desk, treating the number itself as non-negotiable does the stopping for you at the exact moment your own judgment is least equipped to do it. None of these rules require you to feel calm before they work, which is exactly the point. They're built to hold even when you're not. Go back to that moment from the opening. 3 positions deep, chasing a number that was never really about the money. It was never a discipline problem in the way it felt like at the time. The first bad trade was your brain reaching for exactly 0, the way Johnson's research says it reliably will. Every trade after that was the chase Lesueur spent his career documenting, size climbing because the feeling underneath hadn't resolved yet. The fix was never trying harder in the moment itself. It was a rule built long before the moment ever arrived, back when neither pattern had a chance to touch it yet. If this changed how you think about the trade that turned into 3, tell us in the comments how far your own chase has gone before you managed to catch it. Hit like and subscribe for more of this. Thanks for watching.